Hello, Chris. Welcome to the show. I'm so excited to have you on today.
Thank you. I am very happy to be here.
Yeah, absolutely. So I would love to hear from you. What excites you the most right now in the fintech space?
Oh, that's a great question. I am very excited that you know that the growth of fintech just keeps continuing, but the new thing that's happening is I think the US regulators are taking a you know a more forceful view on how fintechs work, and that's very exciting to me. Like I've kind of based my whole company on the fact that the US is a regulated market. And I love to see when regulations happen. I mean, regulators they have two things they do. They keep money safe and they keep money liquid. And as long as that happens, I think the economy is going to do great. And I think fintechs are going to do great.
Interesting. So you're pro regulation in the space. Are there specific pieces of legislation that's working its way through Congress now that you're referring to, or is this kind of just a general attitude in Washington? What are you referring to?
It's more that the regulatory agencies, SEC is a good example, where they are writing letters to the banks and saying, look, this is how we have to manage all these fintechs. Like, if you're a fintech in the US, you need a bank to back you. You can't store money yourself. You have to ask a bank. You can't get a card bin yourself. You have to ask a bank. And the thing is that for a long time, it was kind of the Wild West here. But there's been some notable disasters recently, which we all know about. And because of that, I think that the regulators have said, it's like, look, we got to get a handle on this. And so you're starting to see consent decrees come out. You're starting to see other things from the regulators, both the OCC, but the other folks too, the FDIC and the Fed and everybody.
Interesting. And how much of that, not to be too cynical, but I'm curious how much of that is being driven by the incumbents trying to, and the incumbents in this case being large banks for the most part, but also potentially large fintechs. At this stage, there are a few of those as well, trying to create moats for themselves to protect from disruption and innovation versus how much of it is truly for the sake of keeping the economy safe, protecting consumers.
Sure. I think the vast majority is keeping people safe. I think for really what's happening here is that the regulators weren't even looking at this space in detail. And now that they are, they're seeing everything that's happening, right? They saw the problems with crypto, and that's kind of almost a different issue, but that caused two bank failures essentially. And that really grabbed their attention. And there were some earlier actions this year and last year with with Cross River Bank and Blue Ridge Bank and those folks that it really got their attention about how some of these fintech relationships were being run, or in their case, not being run. Most of the fintechs that I talk to care about compliance, but most of the regulators I talk to are not even sure what a fintech is, frankly.
I want to come back to those. You brought up a couple of topics that I wanted to talk about, including crypto and some of the bank failures that we had. But since you introduced typically we start with the company that you lead, that you founded, Treasury Prime. I'd love to hear from you. In your words, how does it work? I know you sit between banks and fintechs, so it gives you a really good perspective on some of the topics that we're talking about. But tell us, what is Treasury Prime?
It's great. Treasury Prime, we're a software company. We make software for banks and fintechs that connect each other. If you think about it, there is just an enormous number of banks in the U.S. There's about 5,000 banks, about 5,000 credit unions. It's a lot of it. It's a very distributed and dispersed financial system. But the technology is equally fragmented. And so if you actually want to deal with the banking system writ large, it is useful to have a lot of banks that actually work together using a common platform. In other countries, you'd see this like open banking or something like that. But we don't do that in the US. And so Treasury Prime is an answer to that problem. Like, how, if you are a tech company and you want to do a fintech problem or an embedded banking problem and you want to connect programmatically to the banking system, How do you do it? And Treasury Prime has an API that lets you do that. Um, we connect to a lot of different banks. All the banks interact with each other in a true network. And you can use our API to do the things you do at a bank. You can open a bank account. You can deposit money there. You can find your balance. You can issue a card. You can send a wire. You can receive a wire. You can do all that stuff. It is just a regular bank account. And there's nothing different about it than if you walk down and opened up one. That's what we do.
So your customers are on both sides. You have the fintechs and the banks on the other side, right?
Yeah, we're actually a marketplace, and so it's similar to Airbnb or maybe eBay or Uber or something like that, where there's two sides to this marketplace, right? Who are Airbnb's real users? Are they hosts or are they guests? And I think the answer is yes. They're both of those things. And for us, our users are banks and their fintechs. I would say the hard part of the problem for us is banks. There might be 10,000 banks in the US, but really there's way more fintechs than that. And, finding a bank that's willing to do the kind of work that needs to be done to be a good fintech bank, it's hard, right? It's hard. It takes a while.
I'd imagine from a sales and marketing perspective, it is somewhat easier to get to the fintechs than the banks, just in terms of their willingness to adopt new technologies, to work with a tech startup, although you're not that early in the maturity life cycle, but you're still, a startup, so to speak, versus banks, which are very risk averse typically and probably have longer sales cycles. Can you tell me a little more about that, the nature of your growth from both of those sides of the marketplace?
Yeah, you're 100% right. Roughly it's for us, it's an order of magnitude more fintechs than banks. So there's 10x more fintechs than there are banks for us. And part of the reason for that is there's just more fintechs, there's more problems there, but it's also way easier to find a fintech and close them, right? These are companies who are looking for partnerships. They're looking to do things. So when they find us and realize that we have this large network of banks and they can actually interoperate with the banks in some interesting way, that's a very attractive. And our API and the technology is great, of course, but it's really much easier to close a fintech. A bank, on the other hand, is a completely different story. Like almost all the banks that talk to us, they don't know how to be a fintech bank, right? They don't know how to do embedded banking, and they're looking for us for advice and help. And getting up from zero to actually taking their first client is a huge lift, and they have to be willing to invest in that. And the ones that do make enormous profits, but you have to be willing to do it. And for a bank, they're slow. That's just the way it is. Like they're not going to take risks with people's money that they don't need to. And so they're slow and careful. Fintechs are not.
Interesting. So help me understand kind of the value prop to each side of the marketplace. Fintechs need banks in order to do, from a regulatory and practical standpoint, all of the things that a bank typically does, whether it's holding cash, extending credit, risk management, all of those things. It needs the bank, right? The bank wants the fintech as a way to capture assets under management. Is that about right?
Yeah, the bank generally wants the fintech for two reasons. One, it is a cheap source of deposits, assets under management, as you say. And it's also a good source of fees depending on the bank. We have some banks which are large but hungry for deposits, some banks which are new and hungry for fees, and it's a different mix between them, right?
Fascinating. So just for a sense of numbers, I think there's about 25,000 fintechs in the world. In the US, you've got roughly 4,000 banks and 6,000 credit unions, something like that. Is that about right?
Yeah, it's 4,800 banks, but yeah, it's about right. Yeah.
Got it. And you sit in the middle. So is it fair to call it middleware or kind of API as a service type model?
Oh, 100%. Our main product's an API, right? It's an API that connects to these banks. We are interesting, unique in our world is that we do real-time integrations with everyone. Like we have our own virtual ledger that we can run for the banks. That's what they want, and most of them do. But we do real-time reconciliation at the bank side, which from the bank's perspective is great because it increases the safety of the money. And from the fintech perspective is great because it allows us to move money much more quickly than anyone else.
Very cool. But you don't have to take on any risk, right?
No, we don't take on any risk. And this is like a big difference in our viewpoint of the world than kind of anyone else's. Like I led with, we're a software company. We make software. We help our users use the software. That's what we do. Um, a lot of other people like look at this problem and say the best way to do this is to be a bank. And like my last gig was I ran the Fintech group at Silicon Valley Bank. They bought my previous company. And I can tell you, like, it is not the right way to be a bank. That is just like the opposite of the right way. Once you're in it and doing it, you realize, oh, that was dumb. I should not do that. Software is where all the
Care
interesting.
to elaborate?
Well, a bank must be safe. That is one of its main things. So if Treasury Prime grows 10x the next year, everyone's going to be happy. I'm going to be happy. Our users are going to be happier. Investors will be happy. Everyone's going to be happy. But if a bank grows 10x, no one's going to be happy. The regulators will shut them down because they know if you're going to grow 10x, you could just as easily shrink 10x, and that means in some way you're not safe, right? Your money is not safe, and like I said, their remit is to make sure money. The regulators' remit is to make sure money is safe and make sure money is liquid. And you're not going to do that if you're growing and taking the risks on that you'd have to grow that much. You're just not.
Fascinating. You talked earlier about some of the regulation that exists in the US. How is the banking sector or the finance industry in the US different and potentially behind some of the other kind of Western economies that have much earlier adoption of whether it's digital payments or other emerging technologies in fintech?
Yeah, it's a great question. The U.S. has a great economy, just really fantastic, and the fundamentals of banking in the U.S. are good. The very fundamentals. Like we have a very strong system here. We saw in the recent just body blows of SVB and First Republic, and then the crypto related ones. But really, the banking system just dealt with it. It was fine. It was terrifying for a minute, but it was really fine. Um, However, on the operational side, on the technical side, we are so far behind everyone else. Like we're going to launch, the US is going to launch Fed Now in a month or so. And that's going to take, years for real adoption, but it's going to launch soon. That is not, that is not interesting anywhere else, right? The reason that we are like we are is we have such a fragmented banking system. Everywhere else has interesting technology, interesting open banking standards, and we have none of that. Why do we use Plaid to find out our balances everywhere, or whoever? Because Plaid's a great company, it does a great job, but it seems like that should be a standard, right? The users are in control of. Instead, it's in control of a private company. It's kind of an odd thing, and that's not true in other locales.
Is that due to centralization and perhaps the U.S. ethos of kind of stay out of my wallet, stay out of my home, to keep off my guns, like that kind of mentality is the reason why we don't have that centralized payment system infrastructure in the U.S.?
Yeah, I mean, that's certainly part of it. Get off my lawn. Nobody likes that in the U.S. We're all very individualistic. It's true, 100%. That's part of it. I mean, it's best not to forget that. But mostly it's that we're so fragmented. There's not one regulatory agency. There's not even counting the state regulatory agencies. There's at least 4 and sometimes 5, depending on how you count. And there's, like you were saying before, there's 10,000 of these banks and credit unions. It's just a lot. To get anyone to move in a certain direction is hard. Like you look at another country, there's orders of magnitude less banks. It's very few. And, they're bigger, they're more solid, and you can get them to do things together. We're getting 10,000 banks to do things all at once is really, really difficult, especially since, they're not giant firms. Like most of the banks in the US are $1 billion or so in deposits, which sounds really, really big until you realize that means it's about 100 or 200 people who work there. And that's it. And most of them deal with banking, not with technology and operations. So if the Fed or whoever said, I'm going to do a new thing, it's going to take years to roll out, where that is not true in other countries because there's just a few.
Yeah, I've had the opportunity to work in uh, both payments tech as well as in healthcare, and I'm pretty sure that payments tech is by far more cumbersome in terms of regulation and the number of agencies that you have to deal with. You talked about the number of banks, and of course, we're coming out of the most recent banking collapse of three banks, Silicon Valley Bank included, going under earlier this year. Um, but over time, we're trending towards fewer banks. Are we headed towards a oligopoly in banking in the U.S.?
No, I mean, since the the national bank stuff that happened in was that the '90s, or the cross state bank, the number of banks decreases every year. It's true, but it doesn't decrease you can just draw a line and see where we're far, far away from the number of banks that would bring us in line with other countries. Um, like you can see if it continues like this, in a while, it's going to be a couple thousand banks, but still, that's a couple thousand banks. And I know that's like, less than half of where we are now, but it's still a couple thousand. And like you look at a country like Singapore, if you count even all the foreign entities that have banks there, like I think it's less than 100. Singapore's smaller for sure, but they have a great banking system, and partly that's because there's a small number. They get to do what they want, and Singapore is perfectly fine just telling everyone you have to do it this way, and everyone is perfectly fine, doing it that way. Where in the U.S., the regulatory agencies fight with each other, the banks fight with each other. The bigger banks can capture the regulatory people, so they don't do anything the big banks don't want them to do. It's just very different.
Yeah. Well, I'm sure there's pros and cons in both directions, right? We would sacrifice some potential freedom and a privacy potentially in favor of efficiency with a unified system.
The huge advantage to having so many banks is it's simple. It's capitalism. Like I believe in capitalism. Capitalism is great. If you have all these banks competing with each other, the users are going to get services they want, right? As opposed to having if everyone banked at JP Morgan or Bank of America, and those are the only two banks, that's not enough competition actually to get new services out there, to get different rates out there. And that is the advantage here. We have a system that is really um, able to compete with each other and gives the users the best possible service. And like you need that feedback loop. That's what capitalism's all about. And if we like shrunk that down to like 5, 10 banks, it would just not happen.
Yeah, I like capitalism. It's good. So, what happened at SVB? I know that you were there for several years after they bought out your previous startup. What caused the collapse, and anything that we can learn from that going forward, and not just related to SVB, perhaps a Signature and First Republic as well.
Yeah, the First Republic is similar to SVB. The Signature stuff and the Silvergate stuff also, which is another bank that they closed down, are similar to each other. Those are two different categories. One is like very crypto related, right? The crypto money all ran away and you lost all their deposits. But SVB it's a play in three acts, and it's complicated, but SVB made some structural errors, right? They didn't count on the interest rate going where it was going, and they didn't count on their various investments being worth less than they thought. And so when they had a problem and they wanted to, and like that's the first issue. It's like, one, they made a structural mistake. Two, there started to be a problem, right? There started to be folks who were like worried about the structural issue, and they couldn't cover that. They couldn't raise capital to cover it, and they couldn't sell their investments to cover it, or at least not at the rate they wanted to. So it looked like they were completely underwater. Now, that would have been perfectly fine if everyone had kept their deposits there, because the only thing that was in danger was if everyone took all their deposits away, there wasn't enough cash to cover it. That was really the only danger. SCB was going to have a bad quarter or a bad year, but it just doesn't matter. It still would be a decent business. But then everyone did take their money out. And the only way that SCB really could have stopped that was do great client management, and they did not do great client management. Banks think that deposits are sticky, and that's why they can do long-term loans. Um, and in most cases, deposits are pretty sticky. People have the same bank account for like decades. But everyone at SVB left because they're techie, they have no problem moving their money around, and SVB did not say the right things to their customer base to keep them around.
Yeah. It's always fascinating when you're reminded how much of our financial markets and systems rely on animal spirits and just faith in the system. Um, I'm not sure. You talked about client management that could have potentially kept some of the depositor money staying at the bank and not leaving. But from a game theory perspective, there's no benefit to depositors to risk anything and stay there, right? So I remember at the time, I had clients that I had a client that was with SVB, I had a client that was with First Republic, going through this, and from a selfish standpoint, we have there's no upside in staying at a bank that's at risk, and it's the right thing to do to go to that JP Morgan, which is too big to fail, where you're safe. Now, at the end of the day, even those who stayed were all made whole from a depositor standpoint. Obviously, investors lost a lot of money, but um, is it the right thing for a founder to be risking their uh, operating capital, whatever they raise from investors, it's sitting in an account, move it to JP Morgan? Like, what do you lose by doing that? I understand we all lost as an economy with there's fewer competition if we all just moved there. So that's where game theory comes in. But from a selfish standpoint, that's what I'm asking.
From a startup founder's perspective, the JP Morgan offering is an inferior product. That's why. That's what you lose. You're going to an inferior product because you lack confidence or your current product is unsafe. That's why. But I can tell you, finding a new bank for most of these folks is not easy. And I have to disagree with almost everyone, maybe even you. They're like, the right thing to do there is not to go to JP Morgan. I mean, they're a good bank. They're a great bank. But that's not the right move. Don't go to one bank. I still don't understand why everyone's always at one bank. Like, I didn't have one bank account. We had multiple bank accounts. Because the only way, like, I think people should study distributed computer systems, right? The way you can get this not to fail is to have more than one. Like, if one dies, it's terrible. It's a bad day, but you're not dead. It's just a bad day. Like, we had money. We have lots of bank accounts, and like partly because we're a banking software company, and so we do that. But also because my CFO and myself and my co-founder, we know how this works. The number of banks is the way that you can be resilient, not just having one big giant bank.
That's a great point. And the FDIC limit, I think, also comes into play, which is, it's kind of ridiculous that it's the same for individuals and businesses. That cap of protection, it doesn't really come into play when you're talking about millions and millions of dollars and potentially sitting there. What are those things called? Where are they? Scrape accounts where you can protect sweep accounts, right?
Yeah. I'd use this myself. I pretty strongly believe in that you shouldn't keep all your money just in cash at a bank because it's not FDIC insured. It's expensive it's insurance, right? So it's expensive. And as you start to do tens of millions of dollars, and insuring that, it costs real money. And if the bank ever decided to do that, or the Fed, made it, or the FDIC made everyone do that, it would increase the cost of banking. That's, a negative. But on the other hand, it's safer. It's a trade-off. But I use sweep accounts and store stuff in Treasury bills all the time. Like, we have a couple clients, a couple users who do that for us. Like, we use Meow, which is one of them. It's like they sweep it into Treasury bills, and they go through and they end up. There's a deposit network, but mostly it's in Treasury bills at BNY Mellon. Yeah.
Yeah. So that's one way to protect yourself. You talked about some of the other collapses, and those were crypto related. Without getting too much into kind of what went wrong, we know that there's certainly bad actors and there's a lot of volatility in that space, but there's also a lot of innovation and potential as well. Thinking of crypto and blockchain technology, you're in it. You work with them, potentially the fintechs on some of your clients. What do you see is happening right now in the crypto slash blockchain space? I know it's quieted down from the heyday, but the people are still innovating there. So I'd love to hear from you.
Yeah, it's really down. Basically, almost all, so many U.S. banks are just saying no to crypto now. So it's very hard to get fiat currency in U.S. dollars. It's really hard. Um, we have multiple banks do crypto, and most of them said, "I'm not going to do anybody new." They just don't want to do it, and they're too worried about it. Um, I can tell you that the regulators, they're all, this is before, the regulators all came up. The ones who are running the agencies now came up through the 2008 crash. And they all have that image of in their mind of the shadow banking system. There's that graphic which showed the shadow banking system, and they do not want to let that happen again. And crypto's a big part of that, right? And they're like, so they said, well, that seems unsafe, so why don't we just not do it at all? And it makes the crypto thing harder, at least in the US.
Mm-hmm. Are you seeing any light at the end of the tunnel there? Or are there new opportunities for crypto startups or blockchain startups emerging? Or is it going to be quiet for a while?
I think it'll be quiet in the US for a while. I don't think it'll be quiet everywhere. Like the US is different. Um, uh, I do think that what we're starting to see is people are switching to three different camps. One is they're just treating it as, a commodity, as an asset. I'm going to buy some Bitcoin. I'm going to store it. There it is. It's good to go. They're not going to use it for transactions. They're just going to store it. And that's fine. It's gold. It's fine. And, the other thing that they do is, some of the DeFi stuff's pretty cool, right? It's very interesting. And that you can start to do some more programmatic, more complicated banking operations here. The thing that we have to do is keep iterating on that, because the crypto companies are still not at the stage where banking is now, right? They repeat the same failures that banks have repeated for hundreds of years. Like, we have a stable banking system now. Let's keep that, and crypto needs to catch up. But the third thing I like most excited about is like all the other uses for blockchains, whether it's NFTs or something else, right? The NFT, of some monkey, I don't care. I mean, it's fine. It's fun, right? But I don't care. But really using them to record ownership of things and having things on a blockchain, that's very interesting. That's new. That's different. Let's do more of that.
All right. Didn't one of your previous co-founders start a decentralized insurance company as well?
He did. He is. He's running it right now. Yeah, Zach has that. I think they're based in Bahamas, because the US dollar stuff's tricky. But yeah, he did that. And that's kind of a similar thing. Like, what if you want insurance, and what if you want to, do the economics of that in a cryptocurrency? That's an interesting idea, right? Because frankly, insurance companies, they have to manage assets, and like, well, crypto's an asset. Why don't we use that and manage that and make sure that everyone, can have a safe landing if they need insurance? It's a great idea.
Yeah. 2 years ago, a founder was pitching a similar kind of idea, but it felt very forced, as like you're just trying to do it because it's crypto, but you're not actually solving a pain point of anybody's right now. But I haven't dug into what Zach is doing there, but it sounds like they have a unique thesis that they're going after there. So curious to see where that ends up. Speaking of co-founders, you've worked with some of the same folks over and over again, multiple ventures.
Sure.
What have you learned about choosing co-founders and also investors, right? You have this investors that are previous co-founders or multiple times investing in your companies. What have you learned about choosing them, how to make those relationships last? Any learnings there?
Yeah. Great people stick together. I mean, you find someone who you like working with, who's great at their chosen profession. You want to keep working with them. It's a great experience. I mean, some of these folks are lifelong friendships for me, but they develop from a professional relationship rather than the other way. And I always say it's like the first thing you should ask a question if you're looking at a new startup, brand new, early stage, is how many people know each other? Because great people want to work together. And I know a lot of the folks who I work doing Treasury Prime with. I've known them for years. Um, you know, uh, Jim is my co-founder. Mike and I all were at that Standard Treasury company together, which got bought by SUV. We ran there at SUV together. We're doing this now. We work well together. I think that um, once you found great people, you should want to work with them, right? The best investment the startup can make is in people. That's the best thing they can do. So do a good investment. That's all.
Yeah. Well, it seems like you've found your tribe of solid people that you surround yourself with and want to continue working with. Uh, let's go down memory lane a little bit. You sold your previous startup, Standard Treasury, to Silicon Valley Bank. Hopefully, that was a good exit. But you actually had a bigger exit before that with Merced Systems, right? It sold for $200 million.
Yep. That's fair. Yeah.
What Walk me through that. Let's start with the day after the acquisition closed. What was going through your mind? The money's in the bank. Um, what are you doing the next morning?
It's a good question. I'll take it even further back. It wasn't a company I founded, but I had a significant stake in a .com company that ended up being worth nothing. On paper, I was worth this enormous number. And in reality, I made $60,000 off of the whole. Did I say 20 million? No, I did not. I said $60,000. Anyway, it wasn't very much. And so I realized that it's very volatile. And so when the money landed for Merced, we celebrated. You took a moment. We had a nice dinner. We everyone congratulated each other. We took some of us, took a little time off. Not that much time, but took a little time off. And then most of us just got back to work. We do it because we like the work. I know different people have different motivations. For me, I like the work, and that's why I'm doing it. Right? It's not that I'm searching for some mythical number, and then I'm going to be done once I hit that number. The number is just a number. It's convenient to have money, right? But that's not actually the goal. The goal is to build something amazing.
So you can't retire. You need to be building.
Can't retire. Can't do it. Don't want to. You look at I don't know. Think Warren Buffett, Martha Stewart. When are they going to retire? Never. They're going to die. And then they won't show up for work one day, and everyone will know that it's not that they decided to stop; it just stopped.
That's right. How old is Charlie Munger? Is he 90,
Yeah,
99 or?
Yeah, he's still a better investor than I'll ever be, right?
Yeah, yeah. So I got to ask you: does money buy happiness?
No, it doesn't buy happiness, because I know plenty of people with way more money than me who are very unhappy. But there's a certain amount of money which makes it more convenient, right? Makes your life easier. Makes you not have to worry about certain things, and that is very useful. I think that if people say money doesn't matter in their lives, either they live frugally, like a monk, which is fine, or they're fooling themselves. I think most people are just fooling themselves. You don't need the new car, you don't need the big house, but it is more convenient if you can just travel when you want to travel, that you can buy the thing that you need to buy, that you can send your child to the school they want to go to and buy them the things they need. That's more convenient. And so for that, I enjoy having the amount of money that I have, the modest amount that I have. Right?
Nice. Yeah. Typically, folks that say that it's coming from a point of privilege. Money doesn't matter if you have it, right? If you have this, there's a studies show that there is a point in somewhere between I forget the number. It's probably outdated. It was I think it was 80 to 120,000 per year that people start decreasing in marginal happiness and benefit from increased money. Obviously, there's luxuries in life that you can tap into, but when you're struggling for money, money matters a lot. So don't want to take that for granted. Any luxuries or lavish hobbies that you've taken on? What's one thing that you treat yourself to?
No, nothing. I don't know. I grew up very in modest circumstances, like we lived on government assistance for a while. I ate the government cheese, which is like a thing in the U.S. Um, we were very happy as a family. We had a great family, and we still have a great family. But there was stress in the system because, some days were hard, and we were worried about getting kicked out of the house and all that. And now I don't worry about that. My simple, single financial goal was to take care of my family in a house that I liked. That was it. And when I bought this house a long time ago, I have no intention of moving, and I'm very happy here. And the families take care is fine. There is one thing that I do that is kind of odd. I won't let my wife fly anything but first class. I don't fly first class usually unless I'm with her, but I won't let her fly anything but first class. And I don't know why. She says it's a common source of disagreement among the spouses, right? And she says, "Why did you spend this much money?" And I'm like, "I don't know. I just can't not do it." You know.
That's fascinating. Lucky woman.
I guess it's I don't fly. It's not. I mean, unless I'm going. I mean, I'll fly expensively if I'm going far away. But if I'm just going from San Francisco to New York, I just take a regular coach seat or sometimes a slightly bigger seat. But that's fine.
Got it. Cool. Well, you've earned it if you want to treat yourself. Let's get back to Treasury Prime and lessons learned about growth. As the company has grown, what's been the most challenging part of scaling the company?
For us, it's a marketplace. We have a business model that's a little tricky. Like a lot of people think about, like we're an enterprise software business, really, if you think about it. And if you think about the comparisons people often think about are like Salesforce or something like that, right? And if you think about that, it's incorrect because Salesforce can grow as quickly as they can add clients and as quickly as they can build products, right? But for us, we are rate limited by the number of banks that we have in the same way that Airbnb is rate limited by the number of hosts that it can have, right? There's only 2 houses in the world that Airbnb rented or, provided. That's not that much business. So they need more houses, right? More apartments and more rooms and everything else. And we're the same way. We need more banks. I think it's a common misconception in our world that a bank that we have will take 100 clients. Most of our banks will take, maybe 10 a year, like kind of that number. Some of the older ones will take a little bit, will take double that, but it's not 1,000 a year, that's for sure. So for us, it's the rate limiting factor. We have been at this I've been in this for 5 years now, and there is this laddering effect. You add more banks, and that gives you capacity so you can add more fintechs. And then you add some more banks, and you can add some more fintechs. I've had quarters where I've had my growth curtailed, and I've lost business to competitors because I had nowhere to place them. I had to just pick which clients I wanted to sign. And I picked the most profitable ones and took a guess, but I want to take everyone, right? And there's no room sometimes. That's the most challenging part.
Supply constraint.
Yeah, supply constraint. Yeah, we definitely have a marketplace. Like it's 2 sides, and for most people, they don't have that. They have a supplier, right? They have a vendor they're buying stuff from. Like I have competitors who sell. It's a very different model they have, but because I'm building an open platform for banking in the U.S., and they're generally building an API with access to 1 or 2 banks, sometimes 3 or 4, but a small number, and they buy access from the banks, right? The banks are not the client. The banks are a supplier. And that's easier in some ways. And I'm sometimes jealous. I don't think that's a good long-term solution. Because if really the economics are on the bank side, this is all inside baseball, but our biggest clients have a completely different economic deal than our smallest clients. And it's because once you're a certain size, you can just go straight to the bank and bypass us and say, I want a different deal. And that's what happens. They still use our software, though, because we're a software company, not a bank.
Interesting. So from a pricing perspective, how do you price your APIs and your deals from both sides? Who's paying you and how do you figure out the right pricing model?
Sure. All our clients pay us. We're providing value, so they pay us for that.
And the clients being the fintechs.
No, the clients being banks and fintechs. Everyone pays us.
Okay, both sides.
Both sides pay us. We're a software company providing software to these people. The banks pay us a monthly fee, and they pay us for usage if they use it, which they do. And the fintechs pay us a monthly fee, and then they pay us usage if they use it, which they do. And that's how it works. For the banks, what do they get for that? They get deposits and they get fees because they'll charge the fintechs as well. And if the fintechs, what do they get? They get access to the banking network. They get access to a bank that they can work on with compliance to make sure the regulator doesn't shut them down. And they get access to a network of banks. Like our biggest clients are lots of different banks, like they know, just like we were talking before, that the way to have a resilient system is to have multiple entities. And so like our biggest client has, I think it's $800 million in deposits, something like that. I don't know. It's a lot. And, but it's spread across lots of different banks. And we have instant bank transfers between them and our own private, network. And that is different than everyone else. And those bigger clients, like that's an example of one, they get a different economic deal than that. And sometimes the fintechs will just stop paying us and the banks will subsidize their fees.
Got it. With regards to paying for usage, you mentioned that's part of the fee model. How did you decide that? And is it driven by cost? The cost you to serve each, for example, API call. So it's kind of like a cost plus, or how did you come up with that pricing structure?
Yeah, it's a value proposition. Like the more you're using it, the more value you're getting. So the more you're paying for it, right? So if you open a bank account, we charge you, however much we charge you, and then if you keep that bank open every month, we charge you for using that and keeping that account in existence. It does cost us to maintain the account. There's certain things we have to do for that. Our software has to run. There's reporting that has to be done. Our accounts are FDIC insured up to the limit that you know about, and that has to be reported to the FDIC. And that's not a lot of work, but that's an example of work that has to happen. And so we charge like that. If you're sending a lot of wires, we charge for that. There are hard costs associated with wires, or ACH. We do that. If you're using a card, we charge for issuing a card.
Got it. Very interesting. So you've raised several rounds of financing. I think you most recently raised a C round. So a couple questions there. First is how different is the process from your perspective as a founder in those early rounds, seed or Series A, versus raising those B and C rounds? And also, do you plan to continue to raise further rounds on the road? What's the go forward plan?
Yeah, that's a good question. They're a little different. The seed and the A round are very similar. That it's a vision that you're selling, and whatever, story that you have. And if there's traction associated with that, that's a better story. So that's what you're selling. Doing the seed was really easy because, the pitch was, hi, we're entrepreneurs, what we're doing. We've had successful exits. We are the acknowledged world experts in this space, and we are building a software product that we have demonstrated product market fit for. That's easy. Like that, those are easy raises. We were lucky enough that we did our A round with the people we wanted to do it with, people I've worked with for years and who I trust deeply. And Jim and I picked our person we wanted for our A round, knowing we would have to build up to that. And very strangely, they called us and preempted and made us an offer. And it was lower than I wanted. The valuation was lower than I wanted. But I was arguing about it. And then Jim, my co-founder, said, just take yes for an answer. It's like, okay, that's fair. Just take yes for an answer. You want to go to the dance. This is the person you want to go to the dance with. They're asking you to go. Just say yes. Right. So we said yes. We did raise a B round during the pandemic. I always think of it like an A plus round. We did it because we saw an opportunity during COVID to expand the number of banks in our network, and that worked. So we did that. That was entirely for that. And then those were all easy. And the B round was all insiders only. And it was just, the story was, hey, look, we have this opportunity. Let's just raise some capital right now. And that was easy too. The C round was very different. And, I don't know if it's a more difficult, which is very different. These are all growth funds. The story's good, but it's the numbers which are showing whether it works or not, right? They want to see like, okay, what's the growth rate? What's the unit costs? What's your margin like? They want to know what are the fundamentals? How much, how much churn are you experiencing? When you close a bank, how long is it before they generate revenue? When you close a fintech, how long is it before they generate revenue? And what revenue do they generate? And look at cohort analysis. The analysts at some of these growth funds are just astoundingly good. And, once they have access to all the data, it's really, really good. And that's a very different experience, frankly. I'm glad our CFO was there to do that, because at some point I was like, I'm sick of this problem.
Yeah, definitely much more about the unit economics and the growth projections rather than the story at that point.
Yeah, that's right. That's right. You can still do the story and later on, but it's harder. Like basically, if you have an acquisition offer, for example, you can like often get some of the growth people to say yes, but it's mostly it's a spreadsheet. And if the spreadsheet says it's a good deal, then you do it. The spreadsheet says it's a bad deal, then you don't do it.
Right. So growth funding right now is completely dried up, late stage funding. What does that mean for you guys? Do you sacrifice growth for greater profitability in the short term? Does it mean IPOing earlier than you had planned? What's the future look like for Treasury Prime?
Yeah, I mean, we're focused on the same things we're always focused on, which is, the fundamentals of the business. I know it sounds boring, but what we want to do is increase our top line and make sure our margins are good. And that's kind of it from the financial perspective. And I pay attention to that every day, clearly, but it is not how I think about the company. I think about the company as a function of the number of happy customers, right? They have to be happy and satisfied. We are selling software to people for them to use. And if they are happy and are receiving value from it, then we have a good company. If they are unhappy, we don't have a good company, because that means they're not actually receiving the same value for it. And our revenue might look great because, we're the only game in town, or because we have such a lock on, the banking network. But really, if they're not happy, that's a temporary thing. So I'm looking for happiness and satisfaction from our customers.
Fantastic. Last question on this topic before we move to the exciting lightning round. When you raise the Series B, yeah, when you raise the Series B, how much or what percentage of those funds go to engineering and R&D versus sales and marketing? Is it skewed much more towards growth at that stage, or is it still evenly split? How do you think about that?
We're a product company, and we always invest in product pretty heavily. Our head of product and our head of engineering are both like world class. I used to run engineering and product, but mostly engineering. And our VP of engineering is better than I am, and it's really irritating because I thought I was really good at this job until I saw him start to do it. However, you asked like where do we put the funds? Like there has definitely been an increase in the go-to-market side, and that as we grow, that takes a larger and larger percentage chunk as we grow.
Got it. Since you brought it up, I'll ask the question. You traditionally have been CTO. You come from an engineering background. You've always been on that side. But in this company, you stepped in as CEO. Do you miss the engineering piece of it? Do you want to go back to that?
I miss it. I don't know if I want to go back to it. I mean, I'd be happy to go back to it. My ego is not attached to this either one of those job titles. I am CEO because I'm good at it and because I couldn't trick anyone else into doing it. And a CEO is not a great job, right? There's a lot of stress. Everyone's always complaining about something. When there's a problem, it's my problem. When there's a success, it's someone else's success. And that's all okay. But I couldn't get anyone else to be CEO. So I was like, I guess it's me, right? Because I wanted to work on the problem, because I saw that there was a rare opportunity here to create a brand new banking system for the United States. That you could do that right now because of the wild growth of fintechs. that was possible to do. And you have a window of maybe 10 years, and we're like in that window, and that's what I'm trying to do. And I couldn't get anyone else to be a CEO, be our CEO.
Well, it helps that you're good at it, right?
Yeah, I'm good at it. Yeah.
Awesome. So let's move into our exciting lightning round. I'll ask you a few questions. Let me know the first thing that comes to your mind. Sound good?
Yep, I'm ready.
All right. Um, what book, newsletter, and/or podcast do you find yourself recommending most often?
It's not a tech one. It's Heather Cox Richardson, Letters to an American, or From an American, Letters from an American. She's a history professor, and she writes a daily newsletter about current events and news from the lens of American history. I do that. Other than that, the stuff I read, I know this is, everyone does this. I read, Kara Swisher all the time. I read her all. She's great. Or Matt Levine. I read him too.
Well, I had not heard of that history newsletter, so I'm going to check that out. Thank you for sharing that. You talked about being CEO. They say it's lonely at the top. Is that true? And what do you do to combat that?
It's lonely, and it's a job. I have a very strong, supportive personal life, so that makes it easier. My wife is my most important and best confidant and counselor. She's great. I make sure I invest time in having the right people around me. Have an advisor network. I formally have. Co-founder helps. It's you. My co-founder Jim is like he's been the journey with me, so it's easy to talk to him about it. I do invest in coaching. I think that's important. Like, it's important for someone from the outside to say you're doing great or you're doing badly, or maybe this could be better, or maybe this could be worse. And also, it's nice to have someone to complain about. I'm also super lucky, and this is unusual, and you won't be able to replicate this. My general counsel is a great CEO who just doesn't want to be CEO. He was CEO of a public company for a while. Marty's just fantastic and insightful and kind and and tough and all the things you could possibly want. And when I'm feeling particularly under it, I can call him up. This is my general counsel. I can just call him up and ask him questions, and he'll tell me the answer. And I go, oh yeah, that is the right answer. So
that's pretty lucky.
Yeah, it's lucky.
What 3 SaaS tools can't you live without?
SaaS tools. That's a great question. I use Notion all day long. It's a good question. Slack. I use Slack all day long too. And then it would flip between either GitHub or coming up quickly is, the Chat GPT of the world. And that's the one I use of the generative AI things.
Got it. Are you using GitHub Copilot and or ChatGPT, the coding beta, or?
I don't code that much anymore. I mean, I do a little bit once a month just so I can feel like a real person, but I'm still have the chops, so I could still be an engineer if I want to, but really I don't do anything interesting. My VP of engineering says every time I do something, everyone wants to look at it and review my code. And like, oh, don't do that. It's just regular code.
Yeah, they're not gonna let you slide on that.
No, they're not.
What's a misconception that people often have about you?
That's a great question. I don't know. That I tend to be pretty even tempered, and when things are great, I'm fine, and when things are terrible, I'm fine. And I think that that people believe that I'm just so even that nothing can rattle me. And it's like, no, things can rattle me. I just don't let you see it.
Do you keep it bottled up?
Yeah, well, I keep it. It's like sometimes it's just not appropriate to have to complain to I wait until I come home and I complain to my wife
or your coach or your general
my
counsel.
coach or or Jim or anything, something.
Got it. Last one. What's a core value or principle that you live by?
In my startup world, in my professional life, it's that the team is the most important thing. It's my job to pick the right strategy, and I, hopefully do that. But my second and equally important job is to find the right team. In a startup, it is all about execution and smartness and ability to solve new problems. And the team is the most important thing there. Our team is world class. And that's a core value I have. The team is actually the most important thing. We have invested heavily in our people here at Treasury Prime, and I think they're the most important thing. We are happy when they're happy, and we're a better company when they're happy. So let's keep doing that.
I love that. Chris, thank you so much. I so enjoyed every part of this meandering discussion that we had. To close out, tell us, how can people find you if they want to continue the conversation, or learn more about Treasury Prime, and any final words of advice for founders out there?
Sure. For me, email is the best way. You can find my email address. LinkedIn is the other way. Kind of fallen off Twitter. Does anyone use Twitter anymore? I don't know. But LinkedIn is still a thing. I can tell you the advice that I love and I think about the most, and it's not from me. It's from Michael at Y Combinator. So we went through Y Combinator for this gig. And when things are going badly in your startup, it feels like someone's punching you in the face. You just have to get through it. It is hard. However, when things are going great, it also feels like someone's punching you in the face, and you just have to get through that too. It is not an easy problem, but you can get through it. Just keep pushing. You can get through it.
Yep, absolutely. Wise words. Thank you for sharing that. Chris, wishing you much success. Thank you again, and hope to stay in touch. Wishing you all the best.
Thanks. Great conversation. Thanks so much.